Good morning and welcome to this Monday, August 2nd, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Kind of hard to believe we're moving into a new month. August seems like the summer is flying by here. But the market continues to sizzle pretty good as well. We got futures looking up again this morning. We are off earlier highs, but as of, I don't know, maybe 10 minutes ago, Dow was up close to 100 points. The S&P 500 up 16, and the NASDAQ up about 60. So on a relative basis, looks like maybe traders are favoring the NASDAQ as we kick off a new week. But yeah, I mean, it's been a continuing move to the upside. We're going to talk a little bit more about that in talking technically in just a bit. We'll take a look at some of the longer term charts on the key indices. But yeah, for the most part, I think earnings coming in much stronger than expected. And the way the market has been, or the way it moved higher into earnings season, that's what I would have been expecting. That's what I was expecting, and that's what we're getting. But it's not every company. We saw on Friday, and we're going to go through those numbers in just a minute, but Amazon disappointed with its revenues and its revenue outlook. And so even the biggest can disappoint from time to time. I think the numbers were pretty high, very lofty. I mean, Amazon, obviously a great company. And while it may struggle a little bit short term because of the numbers, I think the long term is fine. But from a short term trading standpoint, some of these hits can be pretty big and difficult to withstand. As I always say, holding any stock into earnings is really the riskiest time to be holding any stock. Doesn't matter what you're holding, because even if you're comfortable that a company is going to beat estimates, it does not mean you're going to result in a higher price. Wall Street doesn't always react in that manner. So it's just, more of a coin flip than anything else. I can look at a stock and look at a chart and tell you most of the time whether or not I'd worry about what they're going to report. But still, with this buy on rumor, sell on news type of mentality, sometimes even the best news, you see stocks get slammed. You might see a gap up and then a sell off all day long. Saw that recently with Intuitive Surgical, and then it came roaring back, but came out with great earnings, gapped up, and the stock was down, I don't know, $40 or $50 or something intraday. From I think it opened 970 something, 980, I don't know, and fell all the way back to 940 or 950 before reversing back and finishing at a high last week. So it's just very volatile as you get around the earnings season, and you've got to be prepared for that. You have to understand it before you go in. All right. Anyway, before we get into all of the action from last week, let me take you all over to earningsbeats.com. If you're not already a free Earnings Beats Digest subscriber, I'd really recommend you do so. Try to make it very educational. We use our research platform at Earnings Beats to come up with various ideas. Many of these things we talk about are related to specific trading possibilities. So you can get some ideas off of the newsletter. But all you have to do is type in your name, email address, hit that subscribe button. It's completely free. No credit card required. And you can unsubscribe at any time. So really no reason not to check it out. I know today's Earnings Beats Digest, I gave a bunch of stats through the first couple of weeks of earnings. So starting back, I think on July 13th, when JP Morgan came out with their earnings, I think I went through that week and then the following week. So maybe the first 9 trading days. And I looked at the actual earnings versus the estimated earnings for every company each of those 9 days that had market caps over $1 billion. So just about any company that mattered was included in this analysis. And every single day, the actual earnings either matched or exceeded estimates. I think there was one day we matched. I think every other day, the other 8 days in that period, all beat expectations, and some by a mile. Some days the average beat was about 30%, 20, 30%. I mean, these are huge earnings numbers that are coming out in the market right now. And so those who don't understand why the stock market keeps going higher, don't understand how to value businesses. It's something I did for many years. As a CPA in public accounting, we did have to do valuations from time to time. And what I can tell you is when you're in a high growth environment like we are right now, and you've got low interest rates, you got to think about what are the alternatives to investing. It's not just how, you're not going to pay the same amount for the same situation in different market environments. The market environments matter. So when you've got interest rates down near historic lows, earnings are going to be worth a lot more than when interest rates are higher, because your alternative, you don't have to take the risk to be in the stock market. You can go out and you can buy a 10-year treasury yield and earn 6 or 7%. That was the scenario 20 years ago. You can't do that anymore. If you want a 10-year treasury yield, okay, here's your 1.3%. That's the difference. 1.2%, whatever. So if you can get earnings growth, some of these companies are posting earnings growth of 20, 30, 40, 50% or more. You can put your money to work in companies growing at those rates, or you can put your money and guarantee yourself 1.2, 1.3%. That's the decision that people have to make today that they didn't have to make in year 2000. And the reason I'm referencing 2000 is because, a lot of folks will look back and say, well, the 2000 top, we had PE ratios of X and now they're higher. So therefore we're at a top. Well, I saw similar stories 6-8 months ago. And what have we done? We've just kept going higher. If you're going to play that argument, it's like a broken clock being right twice a day. If you're always pessimistic, if you're always talking about how the stock market's going to go down, you're going to be right once in a while. You're going to be brilliant on occasion. But you're going to lose a lot of money in the meantime while you're waiting for those couple of brilliant moments, because the stock market goes up a lot more than it goes down. Anyhow, I could go on, but let's get into the action from Friday. We had the Dow Jones Industrial Average down 150 points, the S&P down 24, NASDAQ down 105. Honestly, I thought it could have been worse. I thought it could have been a lot worse, because when you get a headline name like Amazon missing their revenue number and then guiding revenues lower in a high growth environment, while Amazon took a hit, I thought the overall market handled it pretty well. And that's a good sign. I think that's a great sign for the market, because money that's coming out of a lot of money coming out of Amazon was finding homes elsewhere in the market. We really didn't see a sell-off of everything because of Amazon. Mid caps, small caps on a relative basis did better, though they were down on Friday, but they held up better than the other major indices. Materials and real estate were the leaders on Friday, kind of an odd combo. And to the downside, of course, discretionary, home of Amazon, the largest holding in the XLY. I think it's 23%. So, of course, the XLY not going to do well when its primary component loses 7.5%, as you can see over here. Also, energy down 1.6%, failing at that 20-day. That's noteworthy, because energy prices, crude oil prices, have been coming up. So we went up, tested the 20, and rolled back over. We need to get back through that 20 to really, I think, begin to right the ship on energy. Now, the other possibility is if we do go back down one more time, remember, this $46 level is pretty key. And if we go down and put in a lower low and get back to that 46 level, and I'm saying lower low based on where we were just a couple weeks ago, that could come with a positive divergence, a higher PPO in play. And that could be a pretty interesting entry point into energy. I'm saying if we come back down, we might break back out to above the 20. If we do, short term, it might be a trade as long as we stay above the 20 to get in on the long side. But I think the best reward to risk would be as if we see this energy group, the XLE, weak in the near term, get back down to that low 46 and a half area, something like that, set a new low relative to where we were a couple weeks ago, and then also at this price support with a positive divergence. That would be a great reward to risk entry, in my opinion. And like I mentioned, Amazon, the big loser on Friday, down 7.5%. gap down. We really didn't see a lot of selling after the open. I guess that was, good news. So most of the selling was on the gap. So market makers said, here, this is where we're going to open prices. And then we just had a battle between the bulls and the bears at that price. We went up, I don't know, 33.60, maybe something like that intraday. I don't remember what the high was, but we did sell off again later in the afternoon, coming back down, closing below the open and on big volume. So the AD line would have taken a hit, and it did, as you can see there, because you're closing in the lower half with heavy volume. And, if there was one warning sign on Amazon, I would just say it was probably that AD line. I'm going to show you the relative chart with the AD line. I mean, AD had been kind of coming down for the last year. Last 8 weeks or so, we were actually trying to move higher. We had a price breakout. I thought Amazon was going to come up with a good report. I really did. Relative strength, you could see, first of all, broadline retail had broken out. Amazon versus broadline retail hadn't broken out yet, but it was up threatening a multi-month high. So I thought maybe earnings would do it there. Did not. And then you can see broadline retail, which had bottomed and looked like it was starting to trend higher versus the S&P, was shellacked on Friday with that Amazon news. So things were starting to look better in that space, and certainly looking better technically with Amazon. But after that gap down, it's back to the drawing board. Long term, Amazon's a great holding. I would have no concerns whatsoever. Short term, as a trader, however, losing the 20-day, losing the 50-day, losing the breakout level, AD line basically trending lower for the last year. I think now Amazon is just kind of one of those I just kind of put on the back burner. I think it's back into a trading range. We'll see what happens from here, but I'm going to need some more evidence technically before I'm going to want to get back into Amazon. All right, let's move on to the 10-year Treasury yield. And not a lot going on in terms of economic reports this week. Today, we do have July PMI manufacturing. The estimate 63.1, June was 62.1, so we're looking for that to expand a bit. The July ISM manufacturing in June was 60.6. We're expecting a slight increase to 60.8. And then June construction spending, it's a lagging. I mean, we're now in August. We're talking about June construction spending. So it is a lagging report, but June is expected to come in with a 0.3% rise. May actually lost 0.3%. So we're looking for a little reversal there. Not a lot out in terms of economic reports this week. It'll be mostly a focus on earnings again. But Friday, we do have the July non-farm payrolls. We'll get a little sneak preview on Wednesday with the ADP employment report. But that July non-farm payrolls, remember last month we had, 850,000 jobs? Going off my memory. I know it was a big number. July, the expectation is 900,000. And the estimates, as you might imagine, are all over the place. I saw 1.1 million. I saw 400,000. So the estimates are all over. I think consensus estimate right around that 900,000 level. So we'll see what happens on Friday. When you look at these, you'd think, okay, we want a big number. We want 1 million. We want 1,000,001. But I think the market reacts more negatively to a better number. I think you want a strong number. I don't think we want 200,000, but I would be fine with 600,000-700,000, because if it's not quite as great as they think, I think that keeps a lid on interest rates. And as long as interest rates stay low, I think growth stocks, technology, many of the areas within consumer discretionary, communication services, the internet group, that area, I think all of those types of things continue to do very well with a moderate growth. And with inflation expected to come back down, that's the way the market seems to be trading to me anyway. I think that all leads to more strength ahead for growth stocks. Financials, you can see on this chart as we continue to move lower. And there is, I think I said 130 or 120 on the yield, but right now 121, 1.21% on the yield, which is down 3 basis points. So it was 124 at the close on Friday. But it is downtrending still below the 20-day. And as long as that continues, then I think financials and industrials will continue to struggle on a relative basis. Now, if you can pinpoint where the yield's going to start to turn back up again, then you probably would want to be overweight these two groups because they'll tend to do well when the yield rebounds. But trying to decide when it's going to move back to the upside, I've tried to look at it. I thought maybe 150 back here. Then I thought, okay, 140, which was the gap up back in February. Went back to this 140 level, tested it, and went higher. I thought, okay, maybe we go to the 140 area. And I think on the weekly chart there, 140 may have been one of the moving averages as well. But we've continued to drift down below further and further. Now, I could make a case right here with the double top, 120. We had that hammer print right at 120, and here we are again at 120. I'd like to see it turn here. I think the market might get shaken a little bit if we were to go back below 1%. First of all, if you know history and you know the relationship of the treasury market and the stock market, when these yields are falling, that tends to create difficulties for the stock market. Not necessarily a huge sell-off, but it can create volatility. It can create a lot of whipsaw action back and forth, a lot of choppiness. And so far, the stock market's been going higher, even though the 10-year treasury yield's been struggling for the last few months. So this is something that bothers me. I've said there are two things that bother me about the market. They're both short-term concerns right now. But the 10-year treasury yield declining bothers me because it's money moving into treasuries. That's what sends the yield down. So it's defensive money. So there's a reason why folks are being a little more defensive right now. And so we need to recognize that. So that's number one. And then the other thing is transports. Transports are not cooperating. So let me pull up the transports and just show you that chart right now. The Dow Jones just went above 35,000, set a new high. What's going on here with the transports? The Dow theory is not confirming right now. Now, it doesn't mean you have to confirm within a certain number of days, but you can see the Dow Jones Industrial Average breaking out to a new high and transports declining. So I'd really like to see the transports get back up through that 20-day moving average. And then if we get, start trading back in an uptrend, then I think I'd feel a little bit better about the transport area, because the market's going to need transports. We're not just going to keep going higher and higher while transports keep going lower and lower. I do not believe that's going to happen. So one of two things is going to happen. Either the transport's going to keep moving lower, telling us the economy is not going to be as strong as we thought, which in turn will probably drag the stock market down with it, or transports are just going through a correction. And if you look at a long-term weekly chart, that's a viable thing here. I mean, transports were at 6,500. They went to 16,000. And look where they were pre-pandemic at 11,000. They went up almost 50% from the pre-pandemic level. So this is an argument that's a sound one. Hey, transports just need a break. They were going straight up. Not going to continue to go straight up. In fact, what I think is probably going to happen is off of this uptrend, don't be surprised you see a cup. The right side starting to move back up. I do not believe the economy is going to weaken as we go forward. I know we've got the COVID Delta variant. Cases are on the rise. But I just don't see the economy shutting down again. I don't know. We'll see what happens. But I believe transports are going to turn back to the upside. I think they're just getting a rest, a well-deserved rest. I mean, it was almost from February to the early part of May. It was almost straight up. I mean, 12,000 to 16,000. That's 33% in about 3 or 4 months. So it's okay to have this pullback here in transports, but it's still something to keep an eye on. All right, let's keep moving here. So the long-term chart here on the S&P 500, now that we're into August, the dog days of summer, August, September, not great for the stock market, especially September. August is, I consider August to be like one of the, maybe the most boring month for the stock market. When I was putting together the seasonality report for our members yesterday, I was just looking at the historical performance within the month. And it's like, it starts out okay, nothing great. First couple of days tend to be strong, tend to be bullish, but not hugely bullish. And then we go through a period of about a week where we're down, but we're not like down a lot. And then we have another period, I think from the 10th through the 17th or 11th through the 17th, where the market tends to do well, but not crazy good. And then even the 18th through the 28th, which is pretty close to that 19th to the 25th period that typically is poor for most months. August, it's down over that period, but not much. And then we finish with a little rally at the end of the year. It's just boring. So I don't know. Right now, I would expect, I'm looking at the S&P 500. I see a negative divergence on the weekly chart. I mean, I wouldn't be surprised if we're sitting here on October 1st and we're not much more above 4,400 than we are right now. I just think, this momentum, we kind of, maybe we go a little higher, but then we got September, which tends to be a drag on the market. We get into that final month of the quarter, earnings subside, and that's when we tend to see more selling and pullback anyway. And with this negative divergence, maybe we get another 100 points in August. I don't know. That'd be another couple percent, but we could give back 100 or 200 in September. That would be 3 to 5%, something like that. And we'd still be, basically right where we are now. But maybe set up a little bit better from a momentum perspective than we are now. I don't know. You try to play these scenarios out in your head. The one thing that I'm pretty consistent about is that we're in a secular bull market. The stock market wants to go higher. I'm trying to call tops. If you're following folks who tend to be bearish, they've probably been sounding like a broken record for a long time, because if you're bearish and you keep trying to call top in this market, you're just looking foolish. Earnings are expanding. The rate of growth, earnings growth is expanding. Interest rates have come back down. Growth stocks are back in favor for the most part. It's a difficult market to bet against. And you can find reasons. I'm seeing a lot of folks looking at breadth indicators. Oh, not enough stocks are participating. Too many stocks are below their 50-day moving average. Too many are below their 200-day moving average. Well, let me just say this. How many times have we come out of a pandemic? Because I don't remember any other one besides this one. So you have to remember, moving averages, they're just mathematical formulas. And so when the numbers are skewed, like they have been in the pandemic, I mean, they were skewed when we went down so fast. And name me another time in the stock market that we've doubled in 15 months. I mean, there aren't many times in history. But this was irrational low. It should have never gone down here to begin with. But when you start looking at the 200-day moving average, 200-day moving average is impacted quite a bit. Look at the slope on the 50-day moving average turning up. And this is just on the S&P 500. So imagine some of these other individual stocks, that just absolutely went crazy for a period of time. I mean, look at Zoom, which went up last year, as much as just about anything. And look at the 50-week moving average. Now, this stock came down to 280, 270, 280. And if you had looked at it a year prior, it had been up more than the double from a year prior, maybe a triple. But it was trading below its 50-week moving average. So you might look at that and say, well, that's a negative. It's below its 50-week moving average. Well, part of the problem is it went up so much that the 50-day is flying to the upside. So as you go through a lengthy consolidation period, you go below. But I don't look at that as a bearish chart. I just look at it as a stock that couldn't sustain a 10-bagger in 8 months or whatever it was. Those kinds of gains are unsustainable over years and years. I mean, you can do that for a short period of time. So Zoom is consolidating. Now, this is maybe a poster child of a stock that moved up on steroids. So they're not all going to look like Zoom, but I'm just trying to explain for me, I just don't think it's rational to look at some of these breadth indicators after a pandemic and compare them to other periods that didn't have a pandemic. Because these moving averages moved up so quickly. These stocks, they've moved up a lot. We've never seen rotation like we've seen this year. I mean, it's hard to keep track of anything that stays strong for more than 3 or 4 months, because it just turns around and goes right back down. Money goes somewhere else. And so you've got all these stocks that are flip-flopping all over the place. And I just think some of these normal breadth indicators, you got to look beyond the charts and the numbers. Sometimes you got to think about things from a common sense perspective. And so I think we're just in a period where it's going to be very difficult to have many of the charts that are normal, if you know what I mean. And it's going to take a while to normalize all this. Probably not until sometime in next year will we be able to go back to what I would call just normal technical analysis. And so moving averages and stocks over and above, below certain moving averages, I think all of that's being impacted, just like everything else has been impacted by this pandemic. What I can say, though, is earnings are strong. They continue to justify the price advance that we have seen in the market, and I think justify a further advance. I said beginning of the year, S&P 500 was at, I don't know, 3,700, 3,800, 3,750. Let's see here. Let's go back to a daily chart. So beginning of the year, we ended last year, that's November, we ended last year 3756. I said at that time we were going to go to 4,700 this year. That was my prediction on the S&P, 4,700, 1,000 points. And after the huge run up we had into the fourth quarter, I got a lot of flack. No way, you're perma bull. Well, here we are at 4,400 with still almost half a year to go. And the best part of the year hasn't hit yet, fourth quarter. I think we'll get to 4,700. 2,200 or 2022, the year 2022. I'm starting to have some reservations. Not that I think we're going to have a bear market, but I wouldn't be surprised to see a bigger correction. And the main reason I'm looking at a stock like Amazon and I'm looking at a stock like Zoom that are still posting incredible numbers, but they ran up so much that their comps, as good as they are, just aren't good enough. And we've got a lot of these companies that are reopening that are going to be running into the same problems next year. And so I don't know how things are going to play out, but I wouldn't be surprised to see us make a big run into the beginning of the year. I wouldn't be surprised to see the S&P early in the first quarter next year over 5,000. And then I wouldn't be surprised to see a 10% correction or more. Again, just kind of throwing some things out there. Anyway, I wanted to go over some other things, and I've done a lot of philosophical talking here. So let's go over a few things. I did send out the seasonality to our members yesterday. One of the things I talked about, technology. Technology does love the month of August. And if you look at this is over the last 10 years while we've been in this secular bull market. Technology relative to the S&P 500 has outperformed during August all but 1 year. So I don't know what the S&P 500 is going to do, but the odds are is that technology is going to outperform it. You can see July and August, very strong months for technology. And we just saw what happened in July. Technology easily outperformed the S&P 500 and essentially held the market up while some of the other areas like materials and energy and so forth all were going lower. So I think, for the most part, this is a welcome sign that we do have the largest sector within the S&P 500 set to move into one of its best relative strength months of the year. If you look at its outperformance, August 1.9% on average, there's only 4 months that are above 1%. And 2 of them are back to back, July and August. So that's what we're in right now. And we're seeing it with technology, a lot more earnings to come. It's going to be hit or miss with some of these companies, but I do believe the ones that are outperforming on a relative basis, we're going to see some good numbers coming out. The more mid-tier to smaller tier technology companies, I'm expecting some pretty good numbers to come out. Let's look at the computer hardware group. So computer hardware versus the S&P 10 years. Look at August, 78% of the time it goes higher. Averages outperforming by 5.8%. Look at July and August. Average outperformance, computer hardware. We're talking Apple. We're talking Roku. Roku reports this week, trying to make a breakout. I'll show you a chart on Roku a little bit later. Last month, I had featured a stock, ISRG. It was one of the, I don't know if it was the top stock or maybe the second stock of the 20 I provided. But you can see ISRG going into July, loved the month of July. There was that gap up I talked about with earnings. Actually, we came all the way back to 925 after opening at 980. And now in the last week, we're back in breakout territory again. So the whipsaw action and the emotional trading that takes place after earnings can be very extreme. But you want to stick with stocks that are outperformers. Here you can see solid AD line. I mean, we didn't even take much of a hit with earnings because we came up off the low later. 1 second. Okay. So anyway, ISRG was a great one. We provide 20 stocks to our members that we like. Historically, seasonally. Doesn't mean they're all going to go up. But if you like a stock, maybe it's just making a breakout. For instance, one stock on the list this upcoming month is Dexcom. I call them Dexcom, DXCM. Look at that breakout. Big breakout, heavy volume. That was earnings related. This is one of the better performing stocks in the month of August historically. So if we go over to the seasonality chart, and just go back the last 10 years, August, DXCM's gone up more than 3/4 of the time, and averages. Now, this isn't versus the S&P 500. This is just absolute performance, but it averages going up 16% just during the month of August. And so then you look at that, and you look at the chart just making a big breakout, kind of put the two together, and short term, if it pulls back, I'd be a buyer of the stock, especially if we get back anywhere close to where we gapped up to on Friday. So we'll see how things go. But DXCM, this is how you can use seasonality along with technical analysis to maybe find some pretty nice stocks. All right, earnings spotlight. Just going to go over a couple of these here. And since the market just opened, we'll be able to see what's going on. Let me get the relative chart out here first. So first up is HSBC. They actually missed on their earnings, 85 cents versus 90 cents. And if you look, it is at a 52-week low relative to the bank index. Relative to its peers, it's not doing well. I would not have expected a good report, and we didn't get one. 85 cents versus 90 cents, a miss. Then you've got Global Payments, GPN, which also trading near trading basically on a 52-week relative low versus software, pulled back quite a bit. AD line's been weak. Stock is down today early on. They beat $2.04 versus $1.89. They came up with good numbers, and at this point, stock market's yawning. Could care less. Now, this was one I was kind of waiting on. Next two, actually. First is Ferrari Race, up against some key resistance. AD line's been strong. We're gapping down today. This is a pretty good report, $1.34 versus $1.19. And what I can tell you is autos like the month of August as well. So watch Ferrari. If we can get this breakout above this triple top, whether it comes today, whether it comes in a week, whenever, I'd pay attention because seasonality favors the overall group. On semiconductor, this was one I talked about last week in the daily market report. Look at this move back to the upside. Didn't break out on the open, but this is a stock that was starting to strengthen last week, talked about it, and now it's adding to that strength. So on looking pretty good, although I'm not going to buy it right below resistance. I either need to see the breakout or I need to wait for a pullback closer to gap support. But they reported 63 cents. Market was expecting 49. Last one I have for you here, CNA. Actual was 125, expected 123. AD line, not bad. As you can see, relative strength, though, not very good in the insurance area. It is trying to get through the 20-day moving average. This stock doesn't trade a lot of volume, though, so not one I'm going to probably pay too close attention to. But they did beat. They're trying to get back through their 20-day. Thought I'd mention it. Last thing up, 3 you must see. So I like to feature on these 3 you must sees just sometimes the candlesticks that give me warning signs. And so I found a couple more that I think you might appreciate. So the first one here is Dynavax Technologies, DVAX. I want to focus on this April 19th candle. Do you see how we intraday had a breakout to, I don't know, close to $12, easily clearing all of these prior tops intraday, and you can see the volume was starting to accelerate intraday. And this may have been right before an earnings report, I don't know, but intraday it was trying to make a breakout. So if you were looking at this maybe at noon that day, you would have seen this big hollow candle taking out these prior highs. You'd have jumped in. If you're a technician and you like breakouts anyway, you'd have probably jumped in and then been mortified the next day when the stock was back down at 8 and change. But that reversing candle right there, when I get a long tail like that and we've got a breakout, we've got increasing volume, there's only one reason why a stock would come back down and fail. And that's because market makers are selling. Technicians are not going to sell a breakout. If I'm holding a stock that's looking pretty good and it's making a breakout, if anything, I might add to my position. I'm not selling, not on the day of the breakout. I mean, maybe a couple days later. But when I see a big breakout like this fail, that to me tells me market makers are shorting. And if they're shorting, I don't want any part of it. Next day, down. Another one recently in July, Upwork. Now, Upwork reported last week and fell. But look what happened here last week before they came out with earnings. It moved up to about $65 a share, clearing the February high, volume expanding. This was a big breakout. And then the carpet got pulled out from under it, came back down, closed below the breakout level. And look at the next day on big volume. Thing had a $10 sell-off. Now it's still sideways consolidating. We're not seeing a lot more selling from there, but that's why I don't like holding false breakouts. Another stock, I mentioned this one earlier. I'm going to wrap this one up. Roku. So Roku starting to strengthen again, by the way. Nice move up. This is looking like an extended cup right here, pulling back into a handle. Stock down again today, down about $5. But it's in the computer hardware space. I just mentioned computer hardware loves the month of August. Roku, let's pull up the seasonality on that and just see. I don't know. Well, the last 5 years, it's gone up every year in August, averaging 29.8% per August. So, it's a pretty volatile, and it's only 5 years. So we're not talking about a huge sample of data here, but Roku does like the month of August so far. And so are we going to get that breakout with earnings? They report on Wednesday. Now, just like Amazon, you might think you're going to have a big report. It can go either way. So if you're going to hold any stock into earnings, you have to understand the increased risks. Obviously, you got a better chance of making money because you're going to have news out. And if the market responds positively, hey, you could have DXEM or you can have ISRG where you get the gap ups. And sometimes you continue to go higher and higher. AMD, another good example. But you also have the ones that gap lower significantly, and those you have to be prepared for as well. All right, let's see what the market's doing, see if we're holding on to those early gains. Dow up 143 points. S&P 20, NASDAQ 52. NASDAQ has lost its relative strength, though, in terms of how it's performing on a percentage basis versus the S&P and Dow. Small caps, mid caps, both outperforming, though, here in the near term, looking pretty strong. So overall, getting off to a good start this week. Again, August, we typically see a little strength at the beginning of the month, but it tends to be a fairly boring month. So I'm expecting the market probably to go higher, but I wouldn't be surprised if we see a little choppiness. Anyway, everybody have a great day. I'll be back tomorrow over at Stock Charts TV at 9 a.m. Eastern, so you can join me over for that show by clicking on this link to Stock Charts TV tomorrow morning at 9 a.m. Eastern. Be back then for your next Trading Places Live. It is a recorded version, but it'll be after the close today, so I'll give you some updated information. Anyhow, hope to see you over at Stock Charts TV tomorrow morning. Everybody have a great day. Happy trading.